Hi everyone, I'm Shelley Koch from the Macau office in Queensland. So I'll be chatting to you about the JobKeeper payment and what it can or can't mean for you. So the JobKeeper payment, essentially the purpose of this is to assist employers affected by the coronavirus pandemic to continue to pay their workers. Now, in order for them to be eligible, they have to prove that if they have reduce their turnover by more than 30% if they're a small business and more than 50% if they're a large business. The difference between a small business and a not small business is a $1 billion turnover. So if your turnover is less than $1 billion, you have to prove that you've reduced your turnover by 30%. So that makes the employer eligible. Then they can make this payment onto their eligible employees. So what makes an employee eligible is they have to have been employed on a full-time or part-time capacity on the 1st of March. And if they're employed on a casual basis, they have to have been employed by 12 months by the 1st of March. They also have to be more than 16 years of age, and they have to be an Australian citizen or the holder of a permanent visa. Temporary residents, unfortunately, do not qualify, with the exception of New Zealanders on the 444 visa. In addition to that, an employee can only receive one JobKeeper payment. So if they're receiving the JobKeeper payment from another employer, they are not eligible for your employment to receive this. A good way that you can have a look at this is to look at their TFN declaration and see if they've ticked on the tax withholding bracket. If they've ticked that on their TFN declaration, then you can be pretty sure that you are their primary employer, and therefore they are probably only applying for the job seeker through you. So please understand that the JobKeeper payment can only be made through the employer. So unfortunately, individuals cannot apply for this in their individual capacity unless they're a sole trader or partnership, which we will get to later. So what happens now is the employer has determined that they're eligible and that they have eligible employees. So what next? Now you have to register with the ATO to show that you want to be registered to receive this JobKeeper payment. Now the link to do that is on the blog, so please follow that link, but it is on the ATO website as well. So you need to register with the ATO that you want to receive the JobKeeper payment. Then you also have to register your monthly income compared to 12 months prior. The JobKeeper payment will be paid to employers for a period of 6 months that they qualify for this. So the good news is for the employers, it comes in and it goes out through wages. So it's an in and an out, and you won't have any tax implications on this. For the employees, it is taxable income. It will be shown as taxable income. So please be aware of this. Employers, you still have to withhold PAYG on this, just as you would their normal wage. Now, what about super? You probably have not been paying your employees exactly $1,500 a fortnight. So what does that mean compared to the employees that you had on your books? If you were paying your employee $1,500 a fortnight, easy. It's in and it's out through your payroll, and you're withholding the same super that you ordinarily would have. If you were paying them more than $1,500, you have to continue to pay them what you normally would have paid them, and the $1,500 a fortnight will subsidize that payment. The super guarantee that you pay on those wages will be based on the wage that you would have ordinarily paid that employee. If you had paid your employee less than $1,500 a fortnight, your super that you pay on that only needs to be based on 9.5% of what you were previously paying your employee. However, you have to pay them the full $1,500 in gross wages. You receive the full $1,500 from the ATO, you have to pay them that full $1,500 in gross wages, even though your super only is based on what they were receiving previously. If you have previously stood down your employee, things haven't been going well on 1st of March 2020, and since then you have stood down your employee, you do have the option to take them back and pay them through the JobKeeper. However, if you're not actually taking them back into your employment, in that they are not coming back and working for you, you don't have to pay them any super. But if they do come back and physically work for you, you have to pay them super based on the time that they are working for you. Remember, you pay them the $1,500 minimum per fortnight, but the super would have been based on, if it's lower, based on that amount, and it's the employer's prerogative whether they wish to pay them more, but they don't have to. They can cap it at whatever they were receiving or they were paying their employee prior to standing them down. Right, so what about the hidden nasties? Please bear in mind that while this is a great initiative to continue having employees working for you and paying those employees, and it is a great stimulus that has been offered, please be aware that the ATO are making these payments a month in arrears, which means as an employer, you are going to be out of pocket for a month's worth of wages. This can be quite significant, especially if your industry is no longer making any income. You still have to pay super on those wages based on what we've just discussed. But if they're in your employment, you still have to pay them super. They also accrue leave if they're on the JobKeeper payment, as well as you may also incur payroll tax obligations and work cover premiums. Finally, be aware that there is also a lot of admin involved. You will have to pay these employees through your books, so you're going to have to withhold PAYG, attend to the super based on what we've just discussed, as well as report to the ATO on a monthly basis. So there is administration involved. Either you'll be doing that or your accountant will be doing that. So there are costs involved in doing that. The final thing to consider is, while we would hope that a lot of employees are being honest and upfront about it, there is a possibility that they may try and abuse the system and receive a JobKeeper payment from more than one employer. Now, the problem with that is because the ATO is paying you a month in arrears, chances are this employee may receive a JobKeeper payment from more than one employer, and by the time the ATO figures that out, you're the one that's out of pocket, not them. So, and it's unlikely that you'll get that amount refunded. So it's something that you really want to consider. One, is this a good quality worker that you really want to retain? And do you have the trust in them that they're not going to be receiving it from somebody else? There are other things to consider. For example, what if your business hasn't been operating for 12 months and you can't compare it to 12 months previously, but you have significantly decreased your income? Unfortunately, the legislation has not dealt with that up front. What they have said is that they're leaving that up to the Treasury. So what you would probably have to do is apply to the Treasury for a special consideration that you have not been operating for more than 12 months. Now, this is not only offered to businesses or to people with employees. This is actually also offered to sole traders and partnerships. However, you can only have one person who is the JobKeeper recipient of this, which is fine in the case of a sole trader. If you have a sole trader business that's decreased 30% compared to the same period last year, you can apply for this JobKeeper payment, nominate yourself as the primary JobKeeper recipient, and you will receive this directly. Just please remember again, this is taxable income, so it will be shown as taxable income. So if you're a sole trader, you want to be putting a bit of money aside for that because you will be taxed on it. If you're a partnership, unfortunately, you can only allocate one person to be the recipient of this JobKeeper payment. So you will have to have that discussion between the partners to determine who's going to be the nominated recipient. It's the same with trusts who were receiving a trust distribution, or directors of a company who previously just received a dividend and did not receive a wage. The ATO is going to be looking out for people suddenly receiving wages, so be aware of that, but you can nominate someone for a JobKeeper payment in these situations, as long as you can prove that the business is eligible because their revenue has decreased by more than 30%. Right, so I think that's everything from me. Please just be aware of the hidden nasties. And like I say, it's a great initiative if you've got good quality workers that you want to retain and you don't have the income at the moment to retain. But just be aware that there is that month lag that you are going to be out of pocket for, and there are other accruals that you will have to take into account, such as super, payroll tax, leave entitlements, and the additional administration. Thanks, Julia.
Thank you, Shelley. I certainly hope everyone got that message that you need to talk to your accountant. It's not as simple as just sign up and register, because there's pitfalls. Thank you so much for that. Well, while we were busy making this webinar on Thursday, Treasury was busy introducing more rules for the JobKeeper payment. We now have a lot more detail on how the concepts explained by Shelley would work. Thanks to Cooper, our editor, for seamlessly cutting this segment into the webinar over Easter. The JobKeeper payment best suits a business that thinks it might trade through okay, but doesn't want to risk it. That is, incurring all those wages and then the sales don't come in. The business owner may be thinking, better to close now and break even than get further into debt. This is where the government is saying, keep going. If your trade drops by 30%, we will subsidise your wages, hopefully to the extent that even with a lower turnover, you will still make a profit, and we will even subsidise your own wage. In this regard, it is a great idea, encouraging businesses to keep on trying. But it is not such a good idea to pay staff if you have stood them down and will continue to stand them down. Consider all the additional costs that Shelley mentioned. There is also a twist in the rules that will actually force you to sack staff you have stood down if you want to continue to reduce staff while receiving some JobKeeper payments. You see, to qualify for JobKeeper payment, you must apply it to all eligible staff, even those ones you have stood down. An employer may be entitled to JobKeeper payment for themselves. So anyone with a turnover drop of 30% or more would be lining up for that. But be careful, if you have staff that you have stood down, all eligible employees must be paid that JobKeeper payment. So you're either going to have to sack those that have been stood down or take on responsibilities for paying them. To quote the explanatory memorandum from the Treasurer, this is word for word, this includes all eligible employees who are undertaking work for the employer or have been stood down. The employer cannot elect which eligible employees will participate in the scheme. This one in, all in rule is a key feature to the scheme. This forces people to sack staff they have stood down and sack staff in order to qualify for the payment for themselves as an employer, for example, a sole trader, or to be able to only pay key staff, they have to sack the rest of the staff. After all, if they have no work for the other staff, why would they go through all the costs and the risk of not getting paid and processing the pays for them on JobKeeper? The employer would also have to weigh up sacking and paying out leave entitlements compared with standing them down and letting them continue to accrue leave entitlements during this period. So yes, you might have to pay them out their leave entitlements because you've sacked them rather than just stood them down. But while they're stood down, they're accruing leave entitlements, and this could go on for 6 months. If you can only afford to keep a few due to a drop in your turnover, then you really have no choice but to actually sack the rest or take the risk. You will have to pay them $1,500 a fortnight for doing nothing and then find the ATO decides you don't qualify. Further details provided in the statement are that to receive JobKeeper payment for an employee, they must provide you with a notice that they agree to nominate you as their employer, that they haven't given such a notice to another employer, and that they do not have permanent employment with another employer if they were only employed casually with you. If the employee is not honest with you in this declaration, the ATO can make both the employer and the employee liable to repay the JobKeeper payment. But the reality is the employer is going to be the easiest target for the ATO. Now, each pay fortnight begins on a Monday, starting with Monday the 30th of March 2020. So that's the start of the pay period, not the end of it. And that goes on for 13 fortnights. The employer must have already paid the wage before they get paid by the ATO. From May, this has to be reported to the ATO each fortnight, probably through single touch payroll. The statement even goes as far as to say that from May onwards, if you have not reported by the last day of the fortnight, you will miss out on that payment. Now, this is a very scary rule because of the time constraints created by an unreliable ATO website, the fact that a lot of people now will be switching to single touch payroll quickly so that they can report, and they're not used to using the software, they'll make mistakes, they'll have trouble getting it to work, and they've got this deadline looming, click past midnight I gather, and you don't care. Well, $1,500 for each one of your employees. Again, risk, risk, risk. For April, you're allowed to report both fortnights at the same time towards the end of the month, which is just as well because it's not all up there yet. There is a concession for employers who normally pay monthly to apportion their payment over 2 periods. Now, to measuring the 30% drop in turnover. With the exception of unusual circumstances, it is comparing a month or a quarter in 2019 against the same month or quarter in 2020. The test is a forecast unless you use March 2020 or April 2020, because you will have those figures. The earliest month you can compare is March 2020 if you choose to measure monthly turnover. Alternatively, you can use quarterly turnover starting with April and to June quarter. From May onwards, if you haven't already qualified you have to self-assess whether your turnover has dropped enough to qualify in the first fortnight of the relevant month. So you're 2 weeks into the month if you're lucky, not even there, and you've got to predict how the rest of the month is going. That happens after May. Because you don't have to report until the end of April, you've got a bit more leniency in April, and obviously March already has happened. But you've got to choose that month, and March mightn't have had much of a drop. In April, you only have to make your forecast by the second fortnight. If you are out a little, you may not have to pay it back if you can show you had a reasonable method of estimation. Examples given are a lack of quotes in a previous month, so if you assumed it was going to be down the next month. If your business has been forced to close, it's not a problem. Obviously, your turnover has dropped. Otherwise, you need to consider that you may well get to the end of the month and not qualify, which is fine if you didn't commit yourself to paying wages that you couldn't afford on a 29% drop of turnover. But the idea I have heard of getting staff in just to sweep the floor might not go if they are not contributing to turnover, as it might turn out that you may be better to completely sack them right from the start, because you might not be reimbursed for their wages if your turnover drops only 29%, 27 or whatever. The Treasurer's explanatory statement says that the turnover for GST purpose is what they will use, but it does not include input tax, supplies or sale of capital items. It is implied that they will use information from the BAS to check your turnover, but that has a whole lot of problems. There's no guidance on how that will work if you are just going to apply the 30% test to 1 month, yet you report your income on your BAS quarterly. Further, there is no guidance as to whether it will be on a cash or accruals basis. One would think that if they're going to compare the period in the previous year, it will have to be on the same basis as you're reporting your BAS. But of course, businesses that issue invoices after work is completed or run accounts, well, their cash received in 1 month is more likely to reflect the previous month, so they put a month behind. The good news is that once you obtain the qualifying 30% drop in turnover, you are entitled to stay in the JobKeeper program for the duration of even if your turnover comes back up. If you don't qualify in April, you can test again in May and so on. But you can't get paid for the previous month if you hadn't got into the system by then because you hadn't had a 30% drop yet. Only goes forward. Employers are not completely locked in. They can withdraw from the scheme. This might be the case if the employer decides just to let their staff go rather than continue with all the job seeker requirements. Warning. Now, the ATO has the option. It's not automatically going to happen, but they do have the option to take the JobKeeper payment they were going to pay the employer and offset it against other tax debts of the employer. So you might not actually get it.